If you're in the market for a car, you're probably asking yourself whether buying, financing or leasing is the best financial option. In this video, I'll cover the 4 main ways to purchase a car, evaluate what the cheapest option is, and discuss some of the other factors that you'll want to consider when making your decision. If you're new to this channel, I'm Matt. I've been a finance consultant for over 10 years. I now run my own company, and on this channel I talk all things personal finance. So let's start with what the 4 main options are to buy a car. First is to buy the car outright and to pay the full cost at the start. With this option you don't have to make any ongoing payments to own the car. The second is finance or hire purchase, which is where you pay a deposit and then borrow the outstanding amount at a set interest rate, which you pay back in monthly installments over an agreed period of time, and at the end of the financing period you then own the car. The third option is to lease the car, which is like renting, where you make monthly payments and then at the end of the contract you give the car back. In the finance hire purchase option, you're paying the full value of the car as you get to own it at the end, whereas in the lease option you're only paying part of the value of the car and then giving it back. The fourth option is something called PCP. With this option you set a term and the time period for the agreement. You pay a deposit and then the company provides the final value for the car and what it will be worth at the end of the agreement. These are then subtracted from the cost of the car to work out how much the loan will be and how much you'll be paying on a monthly basis. At the end of the agreement you have a few options. You can decide to keep the car and pay the final value, you could return the car, or you can use the final value to part exchange the car. The question on which option is the best is a difficult one, and you may be struggling to decide what to go for. You may think that buying a car with cash up front is the best option, as you get full ownership without having to pay interest on finance like in the other options. But on the other side, you may think that leasing or financing is a better option, as you don't have to pay the total cost up front and instead you pay a monthly fee. To try to help you with some of the things to consider when making your decision, I've done analysis on an example which I'll go through now. So to compare apples with apples, I've based this on an average medium-sized family car, and I've picked the BMW 120 Sport, which on the BMW website is priced at £31,065. For each of the options, to make it as like for like as possible, I've based the example on having the car over a 4-year or 48-month time period, on doing the average annual mileage in the UK, which is around 8,000 miles per year, and putting down a £4,500 deposit or initial rental payment depending on which option we're looking at. The deposit amount is just below 15% of the car value. Option 1 is to lease the car. The upfront initial rent payment is £4,500 and then this is followed by 47 monthly payments of £318.64, which equals just under £15,000. In this option you don't have the purchase price or resale value to consider, as you just give back the car at the end of the agreement, so the total cost for the lease option is £4,500 plus £14,976, which equals a total cost of just under £19,500. Option 2 is PCP. The initial rent payment is again £4,500 and the monthly payments are £327.76 for 47 months, which equals a little over £15,000. To make it comparable to the lease option, I've assumed that the car is given back at the end of the PCP agreement rather than purchased, so that means that the total cost is £4,500 plus £15,358, equaling just under £20,000, so higher than the lease option. Option 3 is finance or hire purchase. Based on a deposit of £4,500, the monthly payments are £609 for 48 months, meaning total payments of just over £29,000. And after paying this, you then have full ownership of the car. The monthly payments are far higher than the lease and PCP options because of the way it's calculated, as these are based on the value of a portion of the car, whereas the finance hire purchase option is based on paying for the full car. The total cost for the finance hire purchase option is £33,746, with the extra money over the car value of £31,065 due to the interest paid on financing for this option. To make the total cost comparable to the lease and PCP options, let's say we then decide to sell the car at the end of the agreement. The resale value based on the average depreciation curve for a car means that after 4 years the car will be valued at £15,243. So if I were able to sell the car for that much, the total cost of having the car for 4 years would be £4,500 plus £29,246 minus £15,243, which equals just over £18,500. So based on this example calculation, it comes out as the lowest cost option of the 3 financing options, but it is dependent on the resale value achieved. The final option we're looking at is option 4, and that is to purchase the car outright at the start. To calculate a comparable cost over a 4-year period, it will be to take the purchase price minus the resale value, which equals a total cost of £15,822. Buying the car outright comes out as the lowest total cost option. However, an important thing to consider is the opportunity cost. If you put down £31,000 from the start, it's locked up in the car. The alternative is paying £4,500 in the financing options and using the leftover money from the £31,000 to invest in the stock market or another wealth generating asset. The question is whether you can make better returns from investing versus the additional cost in the financing options. PCP comes out as the most expensive option and is often the one the car dealerships will try to push as they make the most money from it, and it also typically ties you in for longer, as at the end of the contract you may upgrade your car or do a part exchange and enter into a new agreement. There are a few different factors which influence what the lowest cost option is. For example, how much money are you willing to put down as a deposit, what are the current interest rates on financing, and the length of time that you plan to have the car and the future resale value. Let's go through some of these variables to show how changing them can impact the financial outcome. If the resale value is higher, then it's better to own the car, i.e. to purchase outright or the higher purchase option. But if the resale value is lower, then leasing becomes more financially attractive. Another variable is interest rates. If these are lower, then one of the finance options could be better to do rather than buying the car outright, as the cost of loaning money for the car is less and the opportunity cost is higher from not having the money to invest. Whereas if the interest rate is high on the finance options, then putting down a larger deposit or buying the car outright will mean larger savings over the lifetime of the agreement. It's a good idea to model the costs for the different options based on your own personal circumstances. So when making your decision on the best option, there are a number of different financial and non-financial factors to consider. With leasing or the PCP option, one of the pros is that it gives you flexibility. You're able to switch or upgrade your car after a few years, and you don't have the hassle of having to sell your car. And if you're looking to get a more expensive car which can have high depreciation values, then it can make more financial sense to lease rather than buy, and often maintenance issues are covered by the dealer under lease agreements, but check your contract on this. One of the cons of leasing is that you need to keep your car in perfect condition, otherwise you get charged when you return it to the dealer. And there are restrictions with these options, as the car is not yours to keep. For example, there can be restrictions on the amount of mileage that you can do, and if you exceed the threshold, then you have to pay more. With the finance hire purchase option, some of the pros are that you can own a car with limited upfront costs. Once you've paid off the car, you don't have the stress of the ongoing regular payments, and you have full ownership, so you don't have the restrictions associated with leasing. However, the con of financing is that interest payments can be high, which can take up a large chunk of your disposable income each month, making it difficult to save anything on top. You also have maintenance costs associated with ownership, which tend to increase as the car gets older. The final option, buying the car outright, has the benefits of giving you peace of mind. You own the car fully and you don't have the restrictions or the stress of making regular monthly payments after you've purchased it. This option can work well for people who don't mind driving the same car for 5, 8 or over 10 years. However, as I've said before, the main con of buying a car outright is needing to pay large amounts of money up front and the opportunity cost of using that money to invest. As well as this, cars are in general a depreciating asset unless you really know your stuff and have something like a rare vintage car. One way to try to mitigate this is to buy a second-hand car, which is already partway down the depreciation curve at someone else's expense. One thing to note is that this video focuses on the comparison of the cost of purchasing a car. When budgeting for a car, you'll also need to factor in other costs such as car insurance, fuel costs, routine maintenance, road tax, MOT and parking costs. So hopefully the analysis and summary in this video has been helpful in providing some of the key things to consider when buying a car. Feel free to leave any comments, give the video a like and subscribe to my channel. I'll see you on the next video.